Want to trade options like a pro? Understanding implied volatility, or IV, gives you a hidden edge to spot the best entry and exit points. Let me explain this really quick. So, implied volatility basically measures the market's expectations of how much a stock might move. A higher IV means bigger price swings are expected, which makes options more expensive. When IV rises, option premiums increase because traders expect more volatility. Conversely, when IV drops, options get cheaper. This fundamental link means IV is a key driver in options pricing. So OG traders use IV rank and IV percentile to gauge how current volatility compares historically, because a high IV rank might signal overpriced options, which is good for sellers, people who want to write an option or sell an option to collect premium, while a low IV might signal buying opportunities, which is for people who want to buy long calls or long puts, betting on price movement for a stock to either protect current position they have or just generate income in general. High IV might signal overpriced options, good for sellers, while a low IV might signal buying opportunities. A popular strategy is to sell options when IV is high to collect inflated premiums. Some strikes and option types trade at varying IV levels, revealing market sentiment and risk perception. Selling calls on elevated IV ranks combined with skew analysis can improve your timing and risk control. For example, NVIDIA recently spiked with IV rank over 80% after strong earnings volatility. Call option premiums were inflated, especially out of the money strikes, an indicator from skew. Selling a call just above the current price lets you capture premium decay as IV normalized post earnings, profiting even if the stock traded sideways. Another example is Apple's IV rank hovered near 20% usually during calm markets because Apple is usually a slow mover. Options were cheap relative to historical ranges. Buying a put option here provided cost effective downside protection. If volatility rose or the strike price dropped, the put gained value, offsetting losses. Buying options in low IV without confirming your directional view can cause losses, so just buying options based on IV is very risky. IV doesn't predict direction, only expected range. You have to combine it with price analysis. Implied volatility is vital to time your trades smarter. Track IV levels alongside volatility skew. Paper trade high IV sales and build confidence before risking real money. Subscribe and hit the bell for more actionable option insights. If you want a deeper dive into implied volatility, just let me know in the comments. See ya.